Greetings, members one and all of the Salivation Nation. And we've got a very interesting article here that came to us from AUGCH. And this is about gold and about supply and demand. And does it really influence gold prices? Because we have seen some times where the demand and it might be oversupply, and it really doesn't make that much of a move with the prices for gold or silver for that matter. So let's explore this article here. It's from commoditytrademantra.com. Does supply and demand really influence gold prices? The article goes on to say that gold is an enigma. Certainly gold has practical applications. It conducts electricity, does not tarnish, can be drawn into wire and hammered into thin sheets. However, it is the perceived value of the metal that drives the price. Additionally, there is a finite amount of gold available at any given point in time. You cannot take your gold seeds, plant them in the spring, and plan for the autumn harvest. If you have mined the metal, you have it on hand. The straightforward laws of supply and demand will be a key factor in dictating price. And gold supply over a century. Those are some of the basic truths here in the first paragraph here that's really what the bottom line is too. And the finite amount is especially considering that many nations around the world are accumulating gold and holding it in their federal reserves as an empowerment to essentially save themselves in case of a falling fiat system worldwide, not just here in America. The world's appetite for the precious metal has strengthened. According to figures obtained by BizVibe, global gold production surged from just 1,518 metric tons in 1917 to 3,169 tons in 2016. Meanwhile, global gold demand was estimated at $127 billion in 2016. China has been the largest gold-producing country in the world since 2006. Today, China accounts for over 15% of global gold production. Wow. Australia is the second largest producer of gold, with 270 metric tons of gold produced in 2016. Russia is in the third with a total gold output of 250 metric tons in the same year. With a relatively static supply and growing demand, what are the main factors that drive the price of gold? Well, Fed speak. Interest rates have a big influence on gold prices because of opportunity cost. With interest rates holding near their historic lows, bonds and CDs are, in some cases, yielding nominal returns that are less than the national inflation rate. This leads to nominal gains, but real money losses. In this instance, gold becomes an attractive investment opportunity because it's 0% yield, because the opportunity cost of foregoing interest rate based assets is low. The same can be said of rising interest rates, which boost interest-bearing asset yields and push opportunity cost higher. In other words, investors would more likely forego gold as lending rates rise since they'd be netting a higher guaranteed return. That makes sense. Another factor is economic data, such as job reports, wage data, manufacturing data, broader-based data such as GDP growth, influence the Federal Reserve's monetary policy decisions, which can, in turn, have an effect on gold prices. That brings us to the supply and demand economics. As with any good or service, increased demand with constrained or low supply has a tendency to pull prices of that good or service higher. Conversely, an oversupply of a good or service with a stagnant or weak demand can push prices lower. According to the World Gold Council, gold demand during 2018 grew 4% from 2017 to 4,345 tons, with investment demand down 7%. However, gold supply only increased by 1% in 2018, which represents the slowest rate of supply growth since 2008. Growing demand and constrained supply have been a reason gold prices have headed higher since mid-August 2018. But some of the other factors that come into play, there is another intermedium between the gold supply and demand, and that is the electronic markets and the psychology that involves that with the economic data and the Federal Reserve, especially for what they say. And here we can see on this chart the highest level of annual mine production on record, but growth continues to slow. So there we see the year-on-year growth, and then the mine production increasing over the years there. According to the dollar is it's true that gold is a commodity, but since it is also a way to transfer and preserve wealth, there are unique currency effects that drive the price of gold. Since internationally traded gold is denominated in US dollars, as the dollar strengthens, the price of gold tends to go down. The opposite is also true. A weaker dollar usually moves the price of gold goes up because by default other currencies will strengthen. To define it in other terms, when the US dollar starts to lose its value, investors look for alternative investment sources to store value, and gold is an alternative for those investors. And that is why, by the way, it is money. It is the ultimate form of money. It is true that it is also a commodity, but the author leaves out the fact that it is money because of the very definition or because of their very explanation here. Gold is influenced by supply. The world's top gold mining companies each make more than $3 billion in annual revenue, and total gold mined in 2018 reached 3,347 metric tons. More gold is out there, and finding it is big business. But with a finite amount of gold available for consumption at a given time, traditional supply and demand economics play less of a role with gold prices than with commodities like, let's say, corn or crude oil, one of which can be grown, and the other of which is discovered, refined, and consumed by billions of people daily. With gold, interest rates, currency moves, and economic data are the primary factors to watch. Scott Beyer is the author of this. And yeah, I mean, it's interesting, but the fact that Federal Reserve or reserve banks, national banks around the world, central banks around the world are holding gold at a record rate, it seems like nowadays, it's crazy. They themselves know that gold is indeed money, and it's an ultimate store of wealth, as the ultimate safe haven in case of a collapse or a transitioning of the fiat currency systems. And every nation on the earth right now uses fiat currency systems. And going back to how these other factors are, really, you can consolidate all of this stuff into one particular factor that weighs in on gold prices and silver prices too, by the way. And that would be psychology or emotion, or the fear index, the volatility index. All those things have a psychological element to them, and all of those things drive things like the Federal Reserve, what the Fed says, what economic data comes out, and what that means for us, and the dollar index. The dollar index and the strength of the dollar is based off of a myriad of different factors which include economic data, what the Federal Reserve does or says, and the like. But all that stuff, the underlying element to it is psychology or emotion-tied things. And some of that emotion, by the way, can be rational, for sure. In other words, some of that emotion could be driven by hard economic data or facts that lead to either a strong dollar, weak dollar, or the higher gold prices and lower gold prices. But nonetheless, that's what does drive, because we have seen times and cases where it didn't really match up. Those things didn't match up. It was an irrational fear. So there's two types of fear. Is irrational and rational. Not only are those, but there's irrational and rational euphoria that also can play a part in the fear index or the volatility index to give maybe a false sense of stability. And that euphoria, and that may be a strong word, but a sense of calm, let's say, tends to drive a lot today. And I think it's the sense that, well, we don't want things to fail, or something might be too big to fail or the like. But, you know, there is this notion that we are sort of are living on a house of cards, so to speak, in our economic situation. Some people feel like the economy is very fragile, even though it's successful by many measures. There are other aspects of it that are very fragile, and I do tend to agree with that. But we tend to forget that and weigh that aside, to keep things going. We want things to do well, so therefore, in our minds, they are, and we don't want to think about or panic or fall into any kind of fear, which could really spiral things downward. So they don't. That happens on the trading level and the like. And so therefore, I think some of that could possibly play into why we haven't seen gold or silver go up much higher over the years, because everybody wants the economy to do well. But in the end, it's always good to be realistic. And that is why many of us hold gold and silver. We are realistic with it because we know that sooner or later, something's got to give and there will be some sort of economic downturn to come. Post your thoughts below. Would like to extend a multitude of gratitude, y'all, for watching, and encourage you to please rate, comment, share, and subscribe.